Hello, everybody, and welcome to our webinar on maximizing investment and tax savings with a specific focus on cash balance plans. My name is Jessica Barowie. I'm with Owner Resource Group, and I will be your host today. For those of you who don't know Owner Resource Group, we are a private equity firm out of Austin, Texas. We work primarily with family and founder-owned businesses that are looking for a private equity partner to help with their next phase of growth. We're very relationship-driven. Usually we've known businesses for several years before making an investment. But whether or not we work with you, we like to be a resource to business owners. And so in that spirit, we thought it would be helpful to bring in Roundtable Wealth Management and Prime Pensions to speak on a tax strategy that I was previously not familiar with, cash balance plans. So let's bring up our mugshots and I can introduce our speakers. So first of all, Bob Davis, who is Partner and Chief Investment Officer at Roundtable Wealth Management, will be joining us, along with his colleague, Anthony Rossetti, a Director and Wealth Advisor from Roundtable. Gentlemen, welcome, and thank you very much for joining us.
Thank you.
Bob and Anthony have decades of experience working with individuals and business owners on investment management strategy, and that includes tax optimization. And we're also joined by Scott Fite from Prime Pensions. Scott is an actuary and pension consultant and administrator, and has been in the industry for over 20 years. Welcome, Scott, and thank you.
Thank you.
So before we get started, I'll just walk everybody through the agenda and what we'll be covering today. First, these gentlemen will start out by giving an overview of the tax proposals of the Biden administration and what impact they may have on you. And then we'll get into an overview on cash balance plans, advantages and considerations when adopting a cash balance plan, how it works, and who would be a good candidate to adopt one. Finally, we'll walk through some illustrations of what the plan can look like and then answer any questions you may have. So before we get started, I just want to, I just heard someone said that they can't hear anyone. Can you hear me now? Just type in the chat box if you can hear us. Yes, okay, great. We're on. So before we get started, if you do have a question during the presentation, you'll see at the bottom there's a Q&A box. If you just click on that and type in your question, I will make sure that we get to it at the end, make sure it's addressed. So once again, thank you all for coming and to our speakers for their time today, and I'll kick it off to Anthony to start.
Thank you, Jessica. We'd like to start off and, like Jessica mentioned, talk a little bit about the impact of the Biden administration tax proposals as we transition to a new administration, have a Democrat majority controlled Congress, and combine that with a lot of large stimulus that we're seeing flood the economy that's leaving many of us questioning how it's going to be paid for. We feel tax policy change is going to be inevitable. On the next couple of slides, we want to highlight some of the proposed changes that may have the largest impact on business owners and talk about a retirement plan strategy that may help alleviate some of these tax burdens. So first and foremost, talking about income and corporate tax rates. Right now, corporate tax rates are at 21%, and the proposal would increase those up to 28%. And when we talk about income tax rates, I want to jump to the next slide and kind of focus more on this chart. Right now, we currently have 7 marginal tax brackets with a top rate of 37%. And the Biden tax proposal would increase that to 39% for the top marginal rate, lowering it to 6 different brackets. Now, the key takeaway on this slide, and where I find this graphic most powerful, is focusing in on that $400,000 number figure. So Biden has repeatedly said that tax increases would not affect those making under $400,000. And I just wanted to highlight that because you're going to kind of see that figure again in number of slides that we talk about with other proposed changes. The second is really the Social Security and payroll taxes. Now, this is really the big elephant in the room. And if this were to pass, this would have a significant impact on high earners. So right now, there is a 12.4% tax on the first $137,700 of income. And that's primarily split between the employee share and the employer share. Now, as many of the individuals on this call are self-employed, you're really paying both sides of that equation. So if I can draw your attention down to the graphic at the bottom, this is kind of what we refer to as the donut hole. And what the proposal would do is keep the tax the same on the same $137,700. And then there would be a gap up until that 400,000, that key figure of 400,000, where no tax would be paid. And then the 12.4% would be reinstituted on any income above $400,000. So that could be a significant impact for high earners. And if we kind of want to quantify this number, if we think about an individual who's making $1 million a year, that comes out to roughly $75,000 of additional tax. And I know we have a number of individuals on this call who are all over the country. So if you're a high earner and you're also in a high income tax state, and let's just use New York City for an example, you could be subject to a marginal tax rate of 63%. So you're really only keeping about a third of what you make. So we feel if this were to pass, this would have one of the largest impacts on self-employed business owners. The third and final one we want to address is the capital gains tax increase. And again, I kind of want to just jump through to the next slide and really focus on the chart again. And what the proposal here is, any income, any individual who is earning income in excess of $1 million will really no longer receive the preferential treatment of current long-term capital gains of 20%. So if you're an earner in excess of $1 million, your long-term capital gains rate will essentially be the same as your ordinary income tax of roughly 40%, 39.6%. And the key to this slide, and although these are all just proposals and we don't have the details of every proposal yet, this could be a cliff. So if you're somebody who earns $1 million and $1, any long-term capital gains will be subject to that 40% rate. We feel this is going to make income management much more important, and individuals are really going to want to start thinking more about planning strategies, maybe such as charitable contributions, or in this case, retirement plan contributions. So this is going to lead us into our discussion on cash balance plans and how they can help you maximize savings and investments while decreasing your taxable income and really making sure you're staying below some certain thresholds that would otherwise increase your taxes. This is a matrix of all of the more common retirement plans out there. And many individuals may be familiar with traditional IRAs, 401ks, or even defined benefit or pension plans, but not many people are familiar with cash balance plans. And we're not going to go through all the details on this slide. And I just want to note that these slides will be available for distribution, so you can reference this at a later stage. But the key point on this slide is to focus on the contribution limits of a cash balance plan. In this example, if we look at somebody who's age 55, they can contribute upwards of $200,000 to a cash balance plan versus just the $58,000 that you can contribute, maximize in a 401k. So you can essentially contribute upwards of 4 times as much in a cash balance plan. So let's talk a little bit about what a cash balance plan is and how they work. The cash balance plans are sometimes referred to as hybrid plans of defined contribution and defined benefit plans. They give you the high contributions that are available in defined benefit plans, but they have a little bit more of the look, feel, and portability of defined contribution plans. And at this point, I want to bring in Scott from Prime Pensions. Scott, can you talk to us a little bit more about how cash balance plans work and some of the similarities between 401ks or defined contribution and defined benefit plans?
Sure, absolutely. Yeah, and as you mentioned, Anthony, um, cash balance plans are utilized when somebody wants to put away more than $58,000. These type of plans, cash balance plans, have something called contribution credits, which allow business owners to put away 100,000, 200,000, or even more into this type of retirement plan. This type of retirement plan, cash balance, the reason it's like a hybrid, it's very similar to a defined benefit plan because it allows you to put away a significant amount for yourself, your partners, even keep employees that you may have. And that can be more than 58,000. So very similar to a defined benefit plan. Also, just like a defined benefit plan, cash balance plans have required contributions. So these plans are not set up where year by year you decide do you or do you not want to put away money. It does have required contributions for a minimum of 3 years. So those characteristics in a cash balance are very similar to a defined benefit plan. But where it's a little bit different and similar to a profit sharing or a 401k plan is each year the owners, the employees will get a statement that will look very similar to the way their 401k statement reflects, where it'll have a beginning balance, it'll have a contribution for an individual. For example, an owner might show $100,000 or $200,000 as their contribution. It'll have some earnings, something called an interest credit, which we'll talk about in a second, and it'll also have an ending balance. So the statement for a cash balance plan and the way cash balance plans work, it's a lot easier to understand than defined benefit plans. Defined benefit plans, just a little bit of a difference between defined benefit plans and a cash balance plan. A defined benefit plan, what we're doing is we're looking at when you retire at age 65, how much money do you need to have in the plan? Where a cash balance plan, similar to a 401k, the business owners can decide how much money they want to put in today instead of looking towards the future. So if a business owner knows that they have an extra $100,000 or $200,000 that they can put away into the plan this year, then we would write the plan document reflecting the amount that they want to receive. That's a contribution credit, how much the money they want to put in for themselves. Interest credit, just to mention, is that it's similar to an interest rate that every actuary assumes the plan's going to grow by. Most retirement plans, and we'll get into this a little bit more later, but most plans today, these cash balance plans, assume that the plan is going to grow 5% each year. My office, Prime Pensions, we typically use a rate between 4 and 5%, which means when you get your statement, you're going to see your account grows by 4 to 5% guaranteed every year.
Scott, kind of just elaborating on the interest crediting rate. I know right now we're in an environment of pretty much historically low interest rates. How does that play into the equation of the interest crediting rate? And have you seen that interest crediting rate really move a lot over time, or does it tend to be pretty steady between that 4 to kind of 6% range?
Yeah, it's been steady at 4 to 6%. Again, we typically use 5% in our office, even with low interest rates today. These are really supposed to be looked at as a long-term retirement plan. So where you're supposed to achieve 4 to 5%. And how do you do that? I know we're going to be talking about that a little bit later on.
Great, thank you. And what about in terms of eligibility? I know in 401ks, they're pretty much offered to anybody of age, either 18 or 21 years, who typically work about 1,000 hours a year. A year. And is the kind of the same eligibility requirements for a cash balance plan? Is it offered to all participants at a company?
Yeah, so they're very similar to cash balance plans, are very similar to the 401k plans. Most of my clients for 401ks and their cash balance plans have a 1-year wait. They typically don't want employees to enter the plan unless they know that the employee is going to work out. Don't get me wrong, I do have 401ks and these type of cash balance plans which allow employees to enter sooner. For example, immediately on their date of hire, or 3 months, or after 6 months of employment. But typically with these cash balance plans, where there is a cost that the company owner has to put in for their staff, they normally want to wait a period of time of up to about a year before they allow the employees to enter. Once the employees are eligible to participate in this plan, they are going to receive those contribution credits on an annual basis. But keep in mind, just like a profit sharing plan or a money purchase plan, there is a vesting schedule that applies to these cash balance plans. And what that means is if a business owner does put money in for an employee, typically it takes the employee 3 years before they're eligible to walk away with 100% of what the business owner puts in for them. And that's something called a 3-year cliff vesting. If they leave before 3 years, the employee, they get nothing.
Great, great. And just to kind of wrap up this slide and move on a little bit, many of our audience members probably have 401ks within their companies and are most likely familiar with the testing requirements. I know cash balance plans are intended to be used for high income earners who really want to put away a significant more amount of money in to the cash balance plan pre-tax. Are they subject to the same discrimination testing between highly compensated and non-highly compensated? And how does that work?
Yes, there is discrimination testing that must be performed by an actuary on an annual basis. I mean, if you think about it, what we're doing here is we're setting up a plan where it's really set up for the key people, the business owners. We're putting away couple $100,000 for the key people, and the cost usually for the employee is significantly less. Maybe in the cash balance plan, the employees are getting 2% or 3% of pay, while the business owners may be getting 100% of their income. So in order to do that, the IRS says it's allowed, but there's a certain series of tests that an actuary has to perform on an annual basis to prove that it's not discriminatory. It looks discriminatory because the owner is getting significantly more, but we can prove based on ages and salaries that it is not discriminatory based on the IRS standards. And these type of plans have become more and more popular. The IRS knows about them. They allow for them. They just want to make sure that you adhere to all their regulations. And if you do, then you can go ahead and shelter a significant amount for yourself.
Great, thank you. So let's move on a little bit and talk about, now that we have an understanding of what cash balance plans are, let's talk about some of the key advantages of using a cash balance plan and why somebody might want to set them up. So first and foremost, and we've mentioned this a couple of times, they have significant tax deductions for high income earners. And if you look at the chart on the right, a 55-year-old, for example, can contribute upwards of roughly $200,000, and that's equivalent to a tax savings of roughly $75,000 of federal if we assume the top bracket of 37%. And I think this is pretty impactful because if we think about it versus a 401k with a profit sharing, your tax savings alone are in excess of what one could contribute to a 401k and profit sharing. In addition, what's really beneficial about cash balance plans is the contribution limits grow as you age. So, if individuals are maybe investing a lot more money into their company in the early stages, as they grow and the company matures, they can kind of back end some of these contributions pre-tax to these plans. Another thing we talked about before is the flexible structure of them, and they can be maintained with defined contribution plans to allow for even greater contributions. But Scott, thinking about the flexible structure, and let's think about maybe you have employees with an aging base, or you have key employees who are much older than some of the other participants. How can you structure the plan design to kind of work around the age demographics within the company?
Yeah, good question. So most of my clients that have cash balance plans also have a 401k profit sharing plan with it. And the reason they have a 401k profit sharing, as you mentioned here, it has a lot of flexibility by doing that. In a really good year, the business owners put away the money for the cash balance, which is required, and they also put in profit sharing for themselves. In a down year, they just put away money for the cash balance. It's not required to put in profit sharing for the business owners. But there will be profit sharing that has to go in for the employees every year with the cash balance. So the way we structure these plans is that we usually give more of the contributions to the staff and the profit sharing, as opposed to the defined benefit plan, because we have a little bit more flexibility there. And the way it works out mathematically, we get more bang for the buck by giving employees their money in the profit sharing. So it's always good, regardless of the ages of the individuals, to have a profit sharing plan with this cash balance plan to keep the overall cost for the staff as low as possible. And that's normally the goal. Don't get me wrong, I do have clients that put away a significant amount for their staff, but I would say the majority of my clients are really sheltering money for the business owners.
Right, thank you. So in addition to the flexible structure, what's also great is you have a wide range of investment options. Most 401ks typically are limited to, a handful of funds that are in a plan lineup, and a cash balance plan can open up the universe of funds and investments that are available to kind of meet those requirements. And we'll talk a little bit about the investments on the next couple slides. And I think, one of the key things, in addition to the large contribution limits, is the assets are protected in the event of lawsuit or bankruptcy. And Scott, I don't know if there's anything you want to elaborate here, or some specific examples you may have seen.
Yeah, for this, it's the same characteristics to cash balance plans as 401ks and other types of retirement plans, where no one can go after these type of assets. They are protected money. And we've seen cases where business owners are sued and people are going after them, their company, but they can't go after these retirement plan assets.
Right. So we talked a lot about, what are the advantages and, what's so great about using a cash balance plan. Well, let's shift gears and talk about some of the key considerations. We mentioned earlier how participant benefits are guaranteed by the employer, and the employer solely bears the investment risk. And we talked about how, there's kind of a fixed rate that stays stable, and that's the interest and crediting rate. But these assets are invested, and they're invested in a diversified portfolio. Scott, can you talk about a little bit how the investment performance affects the contributions to a cash balance plan, and what happens if there's a large surplus or deficits? If we have a really bad year and the market's down 30%, what does that mean for the contributions going forward?
Okay, and I'm going to tie that into a question I see that's out there. Someone asked, what are the minimums? We mentioned that this plan's in existence for 3 years, and I think it ties into this scenario, this slide that's on here now. Normally, the way it works is, the business owner tells us what they're comfortable in funding each year. For example, let's say they want to put away $100,000. The business owner has to really assume that for the next 3 years, they're going to be doing $100,000 a year. That's going to be the minimum amount. It's really $100,000. But if for some reason down the road, there's a year or 2 years where you're not having a great year and you need to cut back on that $100,000 contribution, there is some flexibility where my office can amend the plan to have a smaller amount. When you have this $100,000 and you put it into the plan, you're expected to earn somewhere around 5% rate of return. Well, what happens if you earn more than 5%? Let's talk about that first. So you're supposed to earn 5% a year and you earn 10%. Now you have more money in the plan than necessary. And what that means is that extra money that's in the plan, you can use that to fund future contributions, required contributions. So let's say you have an extra $10,000 in the plan because the investments did well. So the following year, instead of putting in $100,000, you are able to put in $90,000. It basically reduces the minimum amount that you have to put in the plan because the investments performed better than expected. But on the flip side, you're supposed to earn 5%, and let's say you earn 3%. So let's say that you're short $5,000, $10,000. You do have to make up that $5,000 to $10,000, but you don't have to make it up in the following year. You can spread it out over 7 years. It's amortized, meaning if you're short $7,000 the first year, you only have to make up $1,000 per year over the next 7 years. And if the plan turns around and the market goes back up and the investments perform better than the 5%, then that shortfall can disappear, meaning you don't have to make up any additional losses. Really, the goal is in the long term, while you have the plan, to have a 5% rate of return. That's why it's really important to make sure you align yourself with someone that really understands retirement plans and how this money should be invested. And you're not going for the home runs. You're not going for the Tesla stock and trying to get 20% rate of return a year, because in a really down market, it could significantly impact how much money you have to put into the plan.
Right. And so I think, listening to it, I think it sounds like risk management is really key when you're making the investment decisions within this plan. And, an investment professional with experience managing these plans is really important. And what we've kind of done at Roundtable and how we work with some of our clients who have cash balance plans is, depending on the situation and the size of the company, sometimes this can be considered your fixed income allocation. So if we're looking at your cash balance plan and we want to manage risk and manage to a target performance figure, maybe we can structure the cash balance plan to be a little bit more moderately or conservatively invested while helping individuals optimize their, other buckets of their balance sheet and be a little bit more aggressive in other areas. Before we jump into, kind of how Roundtable manages investments, Scott, I thought while we're on the topic of investments, can we talk a little bit about what's eligible to be used in a cash balance plan? And I know we just got a question in about ESOPs being eligible for this type of plan.
Yeah, so the ESOP question, I'm not familiar, I'll be honest. We used to handle ESOP plans, we stay away from it. Normally the ESOPs don't have a type of, it's a completely separate type of plan. So an ESOP plan and a cash balance plan really are completely different types. The ESOP plan is the employer stock ownership plan. That normally is completely separate than a defined benefit plan. And Anthony, I'm sorry, what was your question regarding the investments?
So let's say, can real estate, private equity,
sure.
or hedge funds be used in a cash balance plan?
Okay, so yes, I mean, you are allowed to have any type of investment from the normal stocks and bonds, cash, money market, mutual funds, and you can have other type of investments like real estate, limited partnerships. But I'm going to be completely honest, most defined benefit plans do not invest in these what's called non-qualified assets, meaning they are not typically invested in limited partnerships or land, gold, paintings. You're normally not investing in that because when you invest in those type of assets, you need to have some type of appraisal where you have a market value on an annual basis. And there's also sometimes too much fluctuation in those type of investments. If someone wants to invest, we typically see in investments like land or limited partnerships, real estate, that's typically done on the 401k. Because if for some reason the investment goes down in value, then you don't have to make it up in a 401k like you do in a defined benefit plan.
Mm-hmm. So with that, I want to kind of jump forward and bring in Robert Davis, CIO of Roundtable. Bob, can you talk to us a little bit about how Roundtable approaches investing and some of the capabilities that we have and experiences we have managing cash balance plans?
Sure. Thank you, Anthony, for that. As we think about the appropriate asset allocation for a cash balance plan, it's always good to come back to the purpose of the portfolio and the cash balance plan. And that is to generate the long-term gains at or above the mandated threshold. So remember, too good can be not optimal, and also certainly coming in below that threshold is a bad outcome because the owners have to make up the shortfall. Also, as we think about the asset allocation, it's important to remember, and as we manage the allocation, it's important to remember that the cash balance plan doesn't pay taxes. So long-term and short-term gain taxes, ordinary income tax rates don't apply. Secondly, custodians today have zero commission trading. So the old business school thought process of taxes and transaction costs actually don't apply in many ways when managing the portfolio. So let's look at the available assets, if you will, for a cash balance plan. And ironically, cash in a cash balance plan, we would not necessarily recommend because one, despite it being very liquid, it doesn't really pay anything today. The case where you might have it is if a participant is redeeming from the plan or someone's leaving the company and cash needs to be paid out to that individual, then you would want to have cash. But moving up to fixed income, today, that's somewhat challenging, especially in longer duration securities within fixed income, because we have rising inflation expectations and rising interest rate expectations. So those longer duration assets are really experiencing a lot of volatility today. Now, in order to preserve that safe haven characteristic of fixed income, investors and cash balance plan participants can have exposure to shorter duration securities. And while there's lower yield there, there is the safe haven aspect. Trying to generate additional gains today, we think US large cap equities are a great place. Let's look at the US economy, which is expected to grow at about 6.5% plus this year. So corporations and corporate equities should benefit from that. And within US large cap equities, we think value is a great place to be, primarily because of the increasing COVID vaccine deployments, as well as the large stimulus measures that have been passed and the large infrastructure measures that are expected to be passed later in the year. Along those similar lines, US small cap equities within the portfolio are we expect to do quite well, primarily because small cap equities correlate well with a recovering and growing US economy. Having diversification in the portfolio is important. International developed, we expect to perform modestly this year, and that's primarily because COVID vaccine deployments overseas is going a bit slower, and that may hamper the reopening of those economies. As an example, Germany just extended by 2 weeks, lifting restrictions in their country. Emerging markets, if we think the US will do well, then I think emerging markets could do very well, primarily because they, in many cases, are the manufacturing hub for the United States. And we think of demand for commodities, those come from emerging markets. So again, we think that is a great place to be in the portfolio. Scott touched on hedge funds and private equity. We really don't see that in the portfolio. And importantly, if they were, and a plan participant exits the portfolio, that exiting participant would take with it liquid assets because the private equity and hedge funds are largely illiquid, and that would increase the concentration of illiquid investments for those remaining. So moving to the next slide, again, coming back to the purpose of the portfolio, long-term growth, and the way Roundtable invests in cash balance plans and for portfolios in general, we take a core and satellite approach. And what the core means is that there is a part of the portfolio that will be a long-term hold. And within that, we have core equities and fixed income. With the core equities, think of investing in a passive S&P 500 or Russell 2000. It's really broad market exposure to the equity market. One caveat within fixed income, rather than a passive approach, we like to take an active approach for the core, in that there are technical aspects to the fixed income market that lend itself to to an active manager. Moving out into the satellite, the blue spheres that we see, those allow us to allocate to areas of the market that we think should be an overweight. So it's somewhat tactical in nature. So for example, value versus growth. Growth has been a great place to be for the last several years. Certainly during the pandemic, growth investments have done phenomenally well. But as the economy in the US begins to reopen, the vaccine deployments continue to increase and stimulus measures occur, we think value will do very well. And of course, that's the that's been the case year to date. I would throw small cap in that category as well. As we move out to the gold spheres, real estate, private equity, and hedge funds, while I agree with Scott's view on private real estate in limited partnerships or direct holdings, there are opportunities to own real estate through either liquid ETFs or liquid mutual funds. And certainly in a rising inflationary environment, those assets have correlated well in the past. Before I turn it back to Anthony, and somewhat of a shameless plug, if people want to learn more about the inflation outlook, Washington developments, and the general economic investment outlook, we are doing a webinar with Dr. Mickey Levy from Berenberg Capital Markets. Formerly, he was with Bank of America as their chief economist for many years. He also sits on the Federal Reserve Shadow Banking Committee. So he has really great insights from firsthand conversations in Washington. So if you wish to join us, please go to our website and register for that, which will occur on March 31st at 5 p.m. So after that shameless plug, I'll turn it back to you, Anthony.
Thank you, Bob. We're looking forward to that as well. I think it's going to be some interesting content that you guys put together. So as we kind of start to wrap this up and get ready to maybe take some additional questions, let's talk about who are good candidates for cash balance plans. First and foremost, it's employers who are looking to make contributions for themselves and key personnel that exceed the defined contribution limits currently at $58,000. Scott mentioned this a little bit earlier. You want to make sure that the business is consistently producing steady revenue and cash flow for at least 3 to 5 years. The last thing the IRS wants to see is somebody who just has an exceptional year who is trying to, reduce their taxable income and make a one-year contribution. That's typically not what these plans are intended to be used for. Also, demographics where key employees are older on average than the rest of the employees. And again, if you're already funding an employer contribution of 5% or more, or would be interested in doing so. So when we talk about kind of combining the plans, and as we start to wrap up and take some questions, we want to go through a couple illustrations that show really the impact on cash balance plans and how they can be used in conjunction with 401ks, profit sharing, and safe harbor plans. So Scott, do you want to walk us through some of these? I know we said we're going to distribute the slides afterwards, so we don't need to get in all the details, but let's kind of highlight some of the key points in some of these exhibits that we're going to go through.
Sure, absolutely. So what you're seeing on the screen right now, there is no cash balance plan. This is what my average client has, which is a 401k with some type of company contributions like profit sharing and safe harbor. The way we set up our plans, as you can see, the contributions are skewed in favor of the owner, meaning that we do not have to give the employees the same percentage of pay that the owner is getting. The owner here is getting 91% of the contributions that are being funded into this plan. The employees are, yes, they are benefiting. They're getting about, we'll call it 4.5% of pay from the business owner, but most of the money that's being funded is going into the business owner's account. Here you'll see, just like a 401k for 2021, the limit for somebody that's age 50 or older, all the way to the right, on the top right corner, you'll see $64,500. But what happens if this business owner wants to put away more than the $64,500? Then we go to the next slide, where you can see we have another column that's added. And you'll see the second to last column. It says cash balance plan. Now we're adding $125,000 for the business owner. As you get older, you can put away more into the cash balance plan. So someone that's in their, we'll call it 60, this person's 66 years old, technically they could do $250,000 to $300,000, but in this scenario, we're showing $125,000 in the cash balance for the owner, and we're showing about $500, a flat dollar amount for the employees. Typically, the employees will get either a flat dollar amount like $500, or they'll get a percentage of pay, something around 2% of their salary. So what we're trying to demonstrate here in this analysis is that the business owner could put away a significant amount, almost $190,000, and the cost for the employees is not that significant with the addition of the cash balance compared to what they're putting into the 401k and profit sharing plan. One thing I did want to point out before we kind of jump to the next slide and ask any questions is that you'll see there's another person underneath the owner. That person is another person who is well paid, but has no equity or ownership in the business. That person in this scenario, this is a doctor's group, is another physician that's making over $290,000. You'll notice that that person's getting nothing in the cash balance plan and nothing in the profit sharing. And the reason for that is you have somebody that's highly paid, the IRS allows you to discriminate against them. So we hear sometimes that some companies or businesses do not want to set up cash balance plans because they have a lot of people on their payroll that are highly paid and that it would be too expensive for them. Well, keep in mind, we are allowed to discriminate and give them zero if desired. Really, it's the rank and file employees, those individuals that making less than $130,000 that have to receive a benefit in this type of plan. And you'll see I have footnotes down below on everything, and the slides will be shared, but feel free to reach out to me if you have any questions on any of these examples. And we'll jump, is there one more, or Anthony, was that it? Okay. This is just taking it a step further. Instead of 10 employees, now we have 15 employees, and you can still put away a significant amount. These plans work really well in groups that have anywhere from one person. So we have a lot of groups that it's just one owner, no employees, or maybe partners. The cash balance works well with. But here with 15 employees, it still works extremely well. We have groups as large as 50 to 100 people that have cash balance plan because the partners all want to put away a significant amount. Another thing I do want to mention is if you have a group with multiple partners, all the partners do not have to have the same dollar amount. Every partner can have a different dollar amount going into these type of cash balance plans. So you may have some partners that want to put away 100, 200,000, and others where they have other expenses. Maybe they have a mortgage or kids going through college that don't want to put money into a cash balance plan today. Maybe they make it zero, but later on they can always start contributing to the plan if their circumstances change.
Thank you guys for those insights, illuminating on both the cash balance plan and the investment strategy involved behind it. I do have a couple questions here, and just to remind the audience, if you want to ask a question, there is a Q&A box at the bottom of your screen. Just click on that and type in your question. I'll be sure that the panelists get to it. So our first question here, I think you may have addressed the first part of this, but can you vary the amount each year based on profitability or not? And also, can you use this as golden handcuffs for a leadership team to give them a larger payout in the year that you sell the business?
So, and this is Scott, I'll address it. Can it be based on profitability or not? Yes. I mean, what a lot of my clients do, instead of you don't necessarily have to have a flat dollar amount that's put into the plan, like $100,000. You could have it where you put into the cash balance plan as a percentage of what your income is going to be. So if you have not so great of a year and your income is down, then the amount that gets funded into the plan can go down as well. And on the flip side, if you're having a great year and your income is up, then we can do it as a percentage of that high income that you have. But whatever we do for 1 year, we really should be somewhat consistent in future years. So if we have a formula of 10% of pay that you're putting in, then you really should stick to 10% each year. If there's any type of circumstance or business hardship where it needs to be modified, the IRS allows you to do that, but we don't want to be changing it every single year. So for example, last year with COVID, I did have clients where they reduced how much money they were going to the cash balance plan because of obviously the circumstances. And then this year, things have turned around and now they're going back to where they were and keeping the formula consistent with prior years. In terms of the golden handcuffs, well, there's two things. I'm not sure. I mean, I have clients that use golden handcuffs for these type of plans and utilize these cash balance plans. One, you can have a vesting schedule. So if you want to kind of give contributions to management or key people, leadership team, and you want to put away large amounts of money for them, you can. And you could say that they have to be there for a certain number of years, but after 3 years, they get it. So you can't go past the 3 years for the handcuffs. But a lot of my clients, well, not a lot, but I would say a significant number of my clients set up these cash balance plans where they're looking down the road as some type of buyout. So for example, if I have a company that has, let's say, a law firm and there's 5 different partners, the company is funding this plan as part of somebody's buyout. So what this allows you to do is the company puts in money for the partners, and when that partner retires, the amount of money that's in that plan belongs to the partner, and that's part of their buyout. The beauty of that is this money, when they take it out, they're not going to have to pay taxes on it right away. It's not until, because it's still tax deferred. They can roll it into an IRA, and no taxes have to be paid until they start taking the money out. And at that point in time, they will possibly be in a lower tax bracket. Hopefully that answers the question.
Got it. That's helpful. So next question, is the contribution to the cash balance a percentage of salary, or can it be 100% if it's a single member LLC?
So yes, it can be 100. Well, you can do a formula where someone gets 100% of their income, but there's going to be a cap or a maximum amount. And that's really based on the person's age. So for example, somebody that's 35 years old and they're making $250,000 will not be able to put in 100% of their salary into this type of plan. They may be capped because of their age at somewhere around $80,000, we'll call it.
Got it. He says, I'm only 62.
62 probably can do somewhere around 100% of pay, up to a cap of maybe $250,000 to 60.
Great, thanks, Scott. Another question, what are the costs associated with establishing and maintaining a cash balance plan?
So on my end, as the actuary, there's 2 things that have to be done with cash balance plan. 1, there's a setup, and 2, there's annual maintenance. My office, for the last 20 years, we have not been charging for setup of cash balance plans. Especially now, we feel it's not necessary because of COVID. We don't want business owners not to set up a retirement plan because there's an expense. There are some third-party administrators that will charge a fee. The normal fee, just to give you a ballpark, is probably around $1,000 to $2,000, but my office has still been waiving the fee. But on an annual basis, just like it has to be done with a 401k, there's calculations that have to be done. There's some certifications that have to be done by the actuary, and there's something called a Form 5500, which is a tax return for the cash balance plan. It's a little bit more complicated than a 401k. So on an annual basis, you can expect somewhere to spend about a base fee of $2,300. And plus, for each person that's in the plan, there's normally a per participant charge of somewhere around $100. So if you have a small group, you're looking somewhere around $2,500 to maybe $3,000 a year for annual administration on these cash balance plans, which is all deductible to the company.
And Scott, just to add kind of more on the investment management side as well, we at Roundtable are fiduciaries. So we don't charge commissions or anything like that. Our fee structure is solely based on an asset-based fee, and our fees are published on our ADV, and we'd be happy to share that fee schedule with anybody after the call as a follow-up.
Anthony or Bob, do you have any advice just kind of on that note when they are, if you're looking into an investment management firm, what kind of things to look for and what are red flags?
Yeah, I think,
Anthony, you want to take it or go ahead?
Go ahead, Bob. You start and I'll chime in.
Yeah, I think it's important that the manager, 1, is a fiduciary, and then 2, that they have experience doing this. So Scott and I, Scott's firm and my firm, had an experience where an investment manager came in and came in at a rock bottom price, and it sounded great until we both realized that they really had no experience and no idea what they were doing in the cash balance plan management space. So certainly an experienced, you want someone who is experienced and understands the goal of that mandated return and how to achieve it on a risk-adjusted basis. That's critical.
Great. Well, it looks like that is it for questions. If anybody has additional questions, feel free to reach out to me or Scott or Bob or Anthony. We'll be sure that everybody gets copies of the presentation after the webinar. And again, appreciate everybody's time. Thank you to our panelists, and thank you to everybody who took the time to participate.
Thank you, Jessica. And yeah, I just want to add, if anybody is interested, we will follow up with everybody, the attendees afterwards. And if you ever want to sit down for a complimentary review with Scott, Bob, and myself, we're happy to, sit down with you and go over everything to see if a cash balance plan is the right option for you.
Great. Thanks, everybody.
Thank you very much.
Thanks, everybody.
Bye-bye.
Bye.